Let's walk through an example of an impairment as it relates to Category 1, which is property, plant, and equipment, and intangibles with finite lives. So what we have is Viva Enterprises, and they have a bunch of property, plant, and equipment, and also intangibles, and specifically we're given some information on one plant and equipment asset group, and then also on a radio broadcast license. The license has a 10-year term, and the plant and equipment has a useful life of 6 years still. They use straight line depreciation for both of these. Okay, so the management reviewed some events and circumstances, and what they found is that the plant and equipment, it's manufacturing products that have had significant declines in sales. Management expects that this demand for the products will continue to decline. So what we have is one of the impairment indicators present for the plant and equipment group. When it comes to the license, it turns out that expanded satellite radio subscriptions, internet broadcasts, and the use of iPods has caused the company's radio advertising revenues to decline substantially. And the question is, do these constitute impairment indicators? Based on this information, will they need to determine a loss? Yes. Okay, so for our category, we've gone through the asset grouping, and we've gone to the second step where we test, we look at impairment indicators, and we have impairment indicators present for two groups of assets. So let's go forward from here. Basically, we need to be aware that the company's cost of capital is 5%. We may need that if we're going to do present value. First, let's look at a table that shows the remaining life of the two groups of assets and some information. So we have cost less accumulated, so we have our carrying value, and then we have our future cash flows. These are undiscounted. So basically, the remaining life of the plant and equipment and asset group, we only have 3 years where we see future cash flows coming from that group. From the broadcast license, we look and we see a possibility of 6 years in the future we're going to continue to see cash flows. We sum these up. We don't apply any NP, net present value, to it. The total undiscounted cash flows for plant and equipment is $1,380,000. We compare that to the carrying value, which is $2,100,000. Well, guess what? This looks like we might have an impairment. We don't want the plant and equipment to be listed at more than $2 million when we likely have an impairment. Let's look at the broadcast license now. They are summing up the undiscounted cash flows. It looks like 540, and the carrying value is 507. So even though we had an impairment indicator present, the total future cash flows undiscounted are 540. They're higher than the 507. So we do not have to go to step 2 for the broadcast license. And I will just point out that the fair value is given for our broadcast license. It's $455,000. So if we had to go to step 2, this is lower than the actual carrying value, which is 507. So normally we don't have its fair value unless we've had to have an appraisal for it. But in this particular example, we have full information at the beginning of the problem. So let's move forward and work through step 2 for the plant and equipment asset group. In step 2, all we do is we take the fair value, we subtract out the carrying value, and guess what? There it is, impairment loss. Now let's look at what the journal entry is going to look like. So what we do is we take the impairment loss that we just computed and we debit it, and it's $900,000. We debit the accumulated depreciation for all of the plant and equipment. So the total amount of accumulated depreciation is $2.1 million. We combine these, and so plant and equipment is reduced by $3 million with this journal entry. This automatically gets us ready for future accounting. Plant and equipment will be at its right amount. The impairment loss is shown in the appropriate period, and the accumulated depreciation that we had already recorded has now zeroed out. We start over with our depreciation going forward. And let's look at the T accounts. We see plant and equipment started with a beginning balance of $4.2 million. The The impairment, we credited plant and equipment for $3 million. That brings us to its ending balance of $1.2 million. And if you remember, this was its fair value that we just noted in the previous slide. The accumulated depreciation started with a balance of $2.1 million. We went ahead and debited, and that zeroes out to zero. So at this point, we have a new cost basis for the plant and equipment group. It is $1.2 million. We'll figure out its remaining useful life, which in this case is 3 years, and so there's no residual value, so we're simply going to take $1.2 million divided by 3 years. It looks like $400,000 per year going forward.